So, hi guys, welcome back. Today we're going to be looking at Intel Corporation and we're going to be doing the stock analysis on this company. Before we begin, if you do enjoy, consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. Onto the video. So if we look at Intel Corporation, if we look to the right, we can see that in 2020 it had a revenue of close to 78 billion. It's an American multinational corporation and technology company headquartered in Santa Clara, California in Silicon Valley. We can see since the inception on the 5th of June 1981, the stock had a really big rise near the dot-com crash, close to 2000. However, over the last 5 years, the stock has been pretty solid. It has had some really big drops, especially throughout 2020. If we look at the last year, the stock is actually down over the last year, down from about $64 to $57 right now. Between this, there have been quite a big jump. We saw it came all the way down to $44 on the 29th of October, with a high of $68 on the 9th of April this year. However, since April, the stock is down more than 16%, and we're going to be looking at whether this company is a buy in the current market with this recent drop. Just some key things to note, we can see it has a PE ratio of 13, which makes it pretty cheap, especially for a semiconductor company that it is, and many of its competitors trading at valuations that are really, really high. And it has a dividend yield of 2.5%, which is decently solid, especially for a company that is focusing on long-term growth. It's not amazing, it's not like a 4% dividend yield, but a 2.5% dividend yield is still a solid return on your money. So the next thing we're going to be looking at is Intel's 2020 annual report. We can see that in the introduction to their business that they're an industry leader. They're creating world-changing technologies, and they're at the brink of several technology inflections. They're focusing on AI, 5G networks, and the rise of intelligence edge as well. So they focus on data specifically, and this data needs to be moved, stored, and processed, and that's where they operate. If we look at their year in review, that they reached a record revenue of almost $78 billion, with 49% of their data-centric business amid the COVID-19 pandemic. On top of this, they shipped more than 10 nanometer. They shipped a higher volume of 10 nanometer products, higher than they expected at the beginning of this year. They invested close to $13.5 billion into research and development. They reduced their spending by 25.3% of revenue, and that they've made capital investments of $14.3 billion and generated more than $35 billion from operations, of which $21 billion was free cash flow. They returned out of those 21.1 billion, more than almost 20 billion was returned to stockholders, including $5.6 billion in dividends and close to $14.2 billion in stock buybacks as well. So if we look at their revenue compared from 2019 to 2020, we see their PC-centric increase from 37 billion to 40 billion, a 3 billion year-on-year increase. Their data-centric business going from 35 billion to almost 37 billion. There's a 3 billion increase overall as well. So they grew a decent amount in 2020. Their operating income was also up year over year, so was their diluted earnings per share. However, their operating cash flow was down, and so was their operating cash flow was up, and so was their free cash flow was up from 2019 to 2020 as well. So overall, the company performed. It was a positive year in terms of performance for the company, especially if we look at the stock price. The stock price was down over the last year, even though the company was more profitable. However, there were some risks that we will go through later in the video, but overall, in terms of the balance sheet, the company is operating pretty well as of right now. So the next thing we'll be looking at is their strategy looking into the future. From the Intel investor page, they say that the world is changing and driving the need for exponentially more computing. First, we experienced the PC era, followed by the mobile and cloud era as well. And now we're entering an era of distributed intelligence, where computing is pervasive in so many things in our lives. Our homes, our cars, our hospitals, our cities now function like computers. And in a world of distributed intelligence, this is the important part. The three fastest growing opportunities are AI, the 5G network transformation, and the intelligence and autonomous edge. If we look at their priorities, they say that the first priority is to improve execution and to strengthen their core. Their core involves process and packaging, XPU architecture, memory, interconnect, security, and software. They're trying to accelerate their growth as well through capital deployment, and they're also trying to redefine their position in the industry. One of these points is through continuous innovation. They're continuing to innovate across all the areas that are key to product leadership, process and packaging, architecture, memory, interconnect, security, and software. They're creating more innovative XPU platforms to serve diverse new workload opportunities, and also transforming the silicon to platforms to solve customer problems through different customer solution offerings as well. They're also investing to transform their traditional idea model to adapt to a more evolving industry. This means that there's greater flexibility to use internal or external foundry processes. It requires that they continue their advances in silicon technology by leaning into expertise and manufacturing scale as well, while evolving to engage with the ecosystem in new and different ways. To accelerate their growth, the proliferation of data analytics, edge computing, and AI is a diverse and expanding range of computing applications from edge to cloud, and that they have architecture deployed in CPUs, GPUs, accelerators, FPGAs, and different systems there as well. In redefining their position in the industry, they're expanding beyond the CPU to solve their customer problems better and not just deliver parts of the solution. With their XPU portfolio, platform vision, IDM capabilities, and scale, they're able to help their customers tackle their own opportunities. They've also recently announced the Intel Evo platform brand, which is powered by the 11th gen Intel Core processors and their graphics card. Representing that laptop design supported by Intel's Project Athena innovation program as well. So if we look at their financial results, we looked at this previously. Their revenue was up, but their gross margin was their revenue year over from quarter one of 2021 compared to the quarter one of 2020 was down 1%. Their gross margin was down 5.4 points. Their R&D was up 3%. Their operating margin was down 16.7%. Their tax rate was down 16.7 points. The tax rate was down 0.5 points. Their net income was down 41%, and their earnings per share was down 37%. This would have been a mixture of AMD charging into Intel's their market share, but also COVID-19 really disrupting the semiconductor industry, and then the semiconductor chip shortage that the world is going through as of right now. If we look at their upcoming expectations, we see for quarter two of 2020, we see a jump to $18.9 billion, a gross margin of 55%, a tax rate of 13%, and an earnings per share of $1.05, which when compared to the current one is a slight increase over what's expected, but not too big of a jump as well. For the full year of 2021, it's expected $77 billion in revenue, a gross margin of 55% almost, a tax rate of 19%, an earnings per share of $4, and a full year of capital spending of about $19.5 billion based on their expectations as of right now. The next thing we'll go through is some of Intel's PowerPoint presentations that they've delivered over the last year, especially with the transfer into AI and 5G as well. So this was given by Dan Rodriguez, who's the corporate VP of Intel, more specifically in the networks platform group in Intel as well. So if you look at the industry inflections that's trying to drive growth, they have the 5G network transformation, the AI revolution, the edge explosion, and the cloudification of everything. So Intel is transforming the network. So they're transforming the network in three big systems. They have workload convergence, increasing their standards in software that is focusing on the cloudification of the network. The workload convergence is focusing on server-based networking, especially with data servers right now. It's a very big thing in the industry. And then they have a vast ecosystem to increase their innovation and collaboration as well. So the next thing we're going to be looking at enabling network transformation in the 5G era. We can see they're trying to focus when they go into 5G on three main things: bandwidth, latency, and security. as well. So the path to the edge. By 2025, 75% of the data will be created outside of central data servers, and this is another thing that Intel is focusing on as of right now. The next PowerPoint we'll be going through is the state of 5G. This was given by Caroline Chan, who's the Vice President of the Data Center Group in Intel Corporation. These were just some risk factors when coming to looking at forward-looking statements. So none of this is confirmed. This is all expectations looking into the future. Looking at the industry megatrends again, this is the proliferation of cloud computing, the growth of artificial intelligence, and once again, the cloudification of network and the edge. So if we look at Intel's transformative strategy, so they're focusing on a few things here. So first they have the device and things sector, the access edge sector, the core sector, and the data center and iCloud sector. Here they're focusing on workload convergence, network virtualization, and customer and industry collaborations. Yeah. So here we can see where they believe 5G will go into the future and how it will benefit them. So here we see the start of 2G, where you could start calling other people over the internet. 3G was allowed you to transfer larger packets of data over the internet. 4G had faster data and was able to produce more and more users. And 5G will have machine-to-machine connections. It will be really, really reliable and have low latency as well. And this will be able to enhance mobile broadband as well. The biggest thing here will be machine-to-machine data communication. This will be in factories when it comes to building robots, cars, and controlling, let's say, everyday appliances, such as, let's say, your toaster from your phone. And all of this will be done through the increase in 5G. So if you look at the network and edge computing, this will also be accelerated by 5G. This will be in autonomous cars, robots, stuff like that, accessing larger and being able to transport more data at once. And overall, this will be a $65 billion opportunity by 2023 for Intel, out of which $10 billion will be in autonomous driving, which is silicon and other services. About $30 billion will be in Internet of Things, and close to 25 billion will be in network as well. With their current 2018 Intel revenue, they're expecting a 20% growth year over year up until 2023. This presentation was given in 2019, so this obviously wasn't fulfilled, but we can still see where they're looking into the future and whether they can achieve this as well. So if we're looking into future growth, in near-term future growth, they recently released their 11th generation Intel Core 8 series mobile processors on May the 11th, which was led by their flagship Intel Core i9, and it was quoted as the world's best gaming laptop processor on May the 3rd, 2021, about a week before they released it. The demand for gaming products and remote working needs are expected to continue and increase in the foreseeable future, and Intel is expected to benefit of this. On April the 12th, they announced that they'll invest close to $3.5 billion to equip its New Mexico operations manufacturer advanced semiconductor packaging technologies, including Foveros, which is its breakthrough 3D packaging technology. And this is expected to provide a boost into its sales in the near term because the demand for this solution is expected to increase in the near term as well. So they've recently been investing heavily into releasing new services with their new Intel generation core, but also investing a slightly more long term when it comes to manufacturing semiconductors as well, which will be very, very lucrative with the chip shortage going on in the world right now. So we'll just be looking at the growth and the financials for a while. So you can see that net income had a small dip towards the middle of the decade, but is once again almost reaching a near high, about 21 in 2020, and is slightly lower in the trailing 12 months. Their earnings per share has been consistently increasing, but stayed solid for the last 3 years, so that's a bit of a concern. Their dividends has been consistently increasing though, and their payout ratio is quite low, so that means that they're able to pay out their dividend at a very healthy rate. Their book value per share has been increasing. That's a good sign. So has their operating cash flow, cap spending, and free cash flow. So more money is being made by Intel, more money is being invested by Intel, and more money is being kept in Intel as well. If we look at their net margin of 24% is pretty decent, especially for a company of this size, which is manufacturing things. So 24% net margin is healthy, and a return on equity of also 24% is a good use of shareholders' equity, showing that the company is using its money pretty well in terms of making profit of it. Their interest coverage of 33 years is quite conservative, and their financial health of 0.42 also shows that the company does not have too much debt. And if they want to take any ventures into the future, it won't be too bad, and it won't be too risky if it doesn't work out too well, because they have quite a lot of space and more debt that they're able to take at a healthy rate. In terms of their valuation, we can see over the last few years, the price to earnings ratio for Intel has been quite solid. It hasn't gone too much over 15. Only 2016 and 2017 had a price to earnings of over 15. Currently, we have a price to earnings of 12.9, almost 13, which shows that the company is trading cheaper than its 5-year average of 14.5, and it could be a good time to enter the industry if you wanted to. A price to forward earnings of 13.11 is a bit concerning, which means that it's expected that their forward earnings will be less than their current earnings. So that is not a good sign for Intel, especially with you want your price to forward earnings be lower than what your current earnings are. And their PEG ratio of 2.62 is also quite expensive, showing that the company isn't growing at the rate that it is right now. However, in terms of pure valuation, it is paying out a pretty good dividend of 2.5%, and the PE ratio is much cheaper than many of its competitors as well. So one of the last things we'll be looking at today is the technical analysis. We can see the technicals analysis is saying that we're looking at a buy, not a strong buy, but decent enough. So if we look at the chart, let's look at the last 1 year. We can see Intel has remained relatively flat, and the stock price is trading close to the 200-day simple moving average, and the 20-day simple moving average has almost converged there as well, showing that the company is trading at pretty historic lows. You barely find a company trading consistently below or quite close to this 200-day simple moving average for an extended period of time, and this has occurred over the last year. If we look at over the last 5 years as well, this probably shows a better sign that the company is much lower than where it was here over the last 5 years. It's currently trading close to the 50-day simple moving average. And here we can see the stock has had a massive drop over the last few weeks, about a month. So if you do want to invest in terms of valuation, it is a bit pricey. But if you're looking at short-term gain, the stock has recently had quite a big correction. You can see every time it had a correction, it does have a small period of time where it does go up here as well. Same with here. So if you're looking at more short-term gains, I would recommend buying the stock and then selling it off once it goes to 10%, especially with the long-term growth of Intel not looking too promising as it gets overtaken by competitors. And another option I would say would be buy some short put options as well. Pay like some premium up front, especially with the stock coming down. It is expected to rebound slightly. You can make a good return on investment there without having too much of a risk as well. So that brings me to the end of my stock analysis for Intel. I hope you enjoyed. And if you do enjoy, make sure to hit that subscribe button and like the video if you did. And let me know in the comments what you think of Intel as well. So if you do choose to invest, make sure to do your own due diligence, and thanks for watching. Bye.